exercise 1010 tells us this company is going to have some distribution of some stock, and they're going to do it as either a small stock dividend, then they say no, consider it a large stock dividend, and then say no, consider it a stock split. How would that be different? Now keep in mind, a company doesn't get to decide if it's a large or a small stock dividend. If it's a small stock dividend, it's usually less than about 20% of the outstanding shares. If it's a large stock dividend, they have to do it at par. So requirement 2 is clearly a large stock dividend. It's a 100% stock dividend. It doesn't get much larger than that. The first one is a small, because they're saying assume that 10,000 shares is a small amount for this company. And then they're saying assume that 10,000 shares is a large amount for this company. And then requirement 3, they say assume that it's a stock split. We can do that one first. That's easy. The journal entry, there is none. The par value gets cut in half. The number of shares outstanding gets doubled, but there's no difference in the equity accounts, so there's no journal entries needed. Just remember, the par goes down, the number of shares goes up, but the dollar value stays the same, no change. So let's handle the small stock dividend first. Small stock dividend, as you recall, is always done at market value. And they tell us at this point the shares of stock are selling at $30. So these are openly traded shares on a national exchange. The price is $30. That can be established. So we're going to give out 10,000 shares, and it's going to be at $30 a share. Okay? And this is a 10% stock dividend. So of each of our 10,000 shareholders, each one gets a tenth of a share of a $30 stock. Okay, so 10,000, each gets a tenth of a share, and the share market is selling at $30, so that's a total of 30,000. I need you to think that way. Each shareholder gets a tenth of a share. Shares are selling for $30. And yes, if you have an odd numbers of shares, you can get fractional shares. That is not uncommon. Now, we know that the stock is dollar par because they tell us that. Okay? So we have 3,000, we have 10,000 times 10% times $1, because remember, we're giving out a 10% stock dividend, so each of our shareholders gets a tenth of a share at par and a tenth of a share at the market price. That's how we have to handle that. So that's $1,000, and the difference, $29,000, is additional paid-in capital. If you see additional paid-in capital, you know that it has to be a small stock dividend. Now, let's assume that this is a large stock dividend. A large stock dividend is also called a 100% stock dividend. I mean, there are other large stock dividends, but they tell us this one is 100%. It can't get any larger than that. You could have a stock dividend of 70%, 80%, 90%, whatever. This is a large one at 100%, which means for every share you get you get one. And because it's a large stock dividend, we do it at par. Makes the math easy. $10,000 stock dividend, $10,000 common stock. The reason that the folks who are in charge, FASB and the SEC, want to make sure that you do that is because you are taking and making it seem like more people are buying your stock when you issue a stock dividend. And they want to make sure that if it's a large stock dividend where people could be tricked, not diluted as in watered down, that they want to make it the impact as small as possible. So large stock dividends are always done at par, only at par, no additional paid-in capital.